All right. Looks like we've got some people still joining in the waiting room, so we're going to give them just a moment to join in. Welcome everyone. Hey Tina. All right, great. So we'll go ahead and get started here. I think a few more people are going to be trickling in here and there, but that's just fine. Uh, thank you so much, everyone, for joining us today. We know that your time is valuable, and we think this topic is more relevant than ever. Just to set the tone for today, this is a space for learning, a bit of perspective, a bit of calm during uncertain times. We welcome all of you to add questions into the chat window. I'll be moderating the chat today. Tina will be presenting. I'm happy to introduce Tina. She is for those of you who maybe don't know, she is the CEO and president of Portfolio Advisors, as well as the senior financial advisor here with the firm. She is a thoughtful guide to all things planning and investing, someone who has a real knack for turning the complex into clarity. Uh, Before we get started, I will remind everybody to remain muted. There will be an opportunity for Q&A at the end of the session today. We'll try to keep it to an hour, and you're welcome to, again, add questions into the chat window. Anything we don't happen to answer during today's session, we will be following up with those individuals uh, following our presentation here today. So without further ado, I'll turn things over to Tina, and we'll get started here. Thank you.
Thanks, AJ. I just want to confirm you're seeing the appropriate screen, right?
Yes, we.
Okay, great. Sometimes we have technical issues, so just want to make sure. So, hi everyone. Thank you for taking the time to join us today. From panic to plan, smart investing in volatile times. Yeah, we're obviously making a pivot here in terms of what we were going to plan on talking about during our April webinar or March-April webinar. This was originally supposed to be a topic about tax tips, but obviously given some of the recent market volatility, a lot of the headlines we've seen over the last 4 to 8 weeks, we decided to pivot. We're having a lot of conversations with clients about what's sort of happening, how they can position themselves, what changes do they need to consider, what they maybe don't need to consider. So we thought, again, to AJ's point, we thought it was a good idea to kind of talk about something obviously extremely relevant. As you kind of read our disclosures here for our recording today, I just want to kind of provide a friendly reminder. We are recording. You'll be provided a copy of the recording and the slides after our webinar is concluded. We welcome you to throw questions in the chat box, like AJ said. Himself, along with our colleague Andrew Bunavong, who's our marketing director, are going to be monitoring that, and then I'm sort of jumping in with questions. So happy to answer those along the way. Continue to mute yourselves and sit back, relax, and enjoy the presentation. So we thought it would be a good place to start with where we are at today. What you're seeing on the slide here are a couple of things, several things actually, a lot of the news items that you're probably seeing. So right now in the stock market, in the various market indices that are being reported that you commonly see on the news, the Dow is about break even, largest 30 stocks in the market, the S&P 500, largest US 500 companies, a little behind the ball there at about a -2%. The NASDAQ, which is all tech stocks, down about 6%. And then the Russell 2000, which is small cap stocks, down about 6%. So just kind of want to gauge where we're at right now. Economically speaking, so some of the headlines that have come out, the Fed has decided to hold interest rates. You probably saw that here recently, last week. They decided to hold rates steady. We definitely thought differently towards the end of last year, anticipating some declines this year, but they've decided to hold things steady. One of those reasons is inflation. We're seeing, we're still feeling it in our pocketbooks, in the grocery store, et cetera. Cost of goods are a lot higher, continue to climb in price. So again, we're experiencing inflation in a lot of aspects of life. Politically speaking, a lot going on. We're seeing a lot of executive orders out of the White House that are obviously sort of causing concern. One of those that affects a lot of our clients is a possible reduction in Social Security and Medicare benefits. So again, a lot of these policies are concerning, and what we're sort of seeing coming out of the White House in terms of how they can affect individuals. We're seeing a reduction in the federal workforce, so job loss, unfortunately. We've got a Department of Government Agency, or Efficiency, excuse me, that is making some cuts. And then we obviously have some national security concerns as well, kind of seeing some of those headlines too. Overseas, important to recognize, obviously tariffs have been a huge headlines, taking up a lot of the headlines here recently. The war in Ukraine, obviously what's happening overseas, extremely concerning. How is the U.S. getting involved and so on and so forth? We're seeing some of that in the headlines. And then our ally relationships. I think, some of that is coming into question here recently in some of the news headlines we're seeing as well. So I think we just want to sort of set the stage, if you will. It's a pretty big stage, a pretty full stage, but at least get on the same page in terms of some of the things that are driving a lot of this market volatility. So we understand it's an emotionally charged environment, politically charged environment, cause for stability concerns. Obviously, our policymakers are kind of in the midst of that, causing us some concern as well. So I think we fully want to recognize that it's not an easy time. Again, it causes a lot of anxiety in terms of what we're seeing, raising a lot of concerns about how retirees, pre-retirees, and even mid-career professionals are navigating these times. And then how do we sort of plan for shorter term goals? So keeping the longer term in mind, as well as shorter term things that we want to plan for. But I think one of the things we're going to talk about is how to keep that longer term perspective in mind, and generally understanding that markets do trend up over time. We just have a lot of bumps in the road to work through. So setting the stage there, we want to go over kind of a little bit of a framework. I often am talking to clients. AJ and I are often talking to clients, maybe even friends or family, that are obviously sort of trying to manage emotions and things like that through this time. And we're going to kind of walk through a little bit of a framework in terms of how we sort of have these conversations, and try to provide some helpful perspective. We're going to talk about how to manage emotions, kind of keeping your emotions in check, but also factoring in current biases and things like that. We're going to talk about, once we've kind of got a handle on our emotions, we're going to talk about understanding the market. So how do markets actually function? How is information priced into the markets? Some historical data showing us why we don't want to try to time the markets and things like that. And then bringing it down to one of my favorite topics, being financial planning, talking through, how do we focus on what we control? One of the biggest things we can focus on are planning topics. How do we save? How do we spend? Adjusting our investments in accordance to our personal goals, some of the short-term and long-term goals, some of the adjustments that we can make in the portfolio. We're going to kind of focus on some of that. So again, as I kind of work through some of these slides, I welcome questions along the way, and we'll get going here. So let's talk about emotions first. I think one of the things I really like to talk to folks about is information overload. We are inundated with the internet, phone alerts, 24-hour news cycle. Like I mentioned before, it's an extremely politically charged environment. We are just smacked across the face, if you will, with all of this news and information. And I think we have to just try to take a step back from time to time. I also like to mention that, with these different news outlets and mediums and so on and so forth, that their agenda, if you will, is to keep you on their platform, keep you watching the news cycle, keep you engaging on social media, keep you on their website, reading things, and so on and so forth. So, as you may consume a lot of news, maybe all in one time, definitely try to take that in bite size. Definitely try to limit the amount of news and things that you're sort of taking in. I commonly joke with folks or clients that come in our office for meetings that I have two young children who commandeer the living room TV. So I have a 5 and a 2-year-old who are constantly watching kids' cartoons, TV shows, etc. I am actually quite thankful that they take over the TV, because if I watch anything more than 15 minutes of any major news network, I can feel the anxiety rising. I can feel the stress level going up. It is just the way that those platforms are designed. So again, healthy doses of media are important. I tend to personally, I tend to do a lot of reading. I like to read articles online. I like to listen to podcasts. I like to read books about a lot of the things that we've talked about. I find that those mediums tend to help put things into a broader context, giving me more information, research, kind of diving deep a little bit, as opposed to kind of some of the bite sizes that we're used to seeing via video and TV clips and those types of things. So again, just being very, very cognizant of that consumption. Far too often we're having conversations with folks who maybe see or read something on the news. They come in extremely anxious and stressed, and they're making decisions based off of that. So we want to try to encourage, again, a healthy dose of media. So go to the next slide here. So one of the things we like to talk to folks about is how are you sort of going through the decision-making process? And as advisors, we definitely like to help with that. But I often try to recognize in some of these conversations with folks, are we making decisions based off of emotion? Are we stressed or anxious and trying to make a decision in that sort of state? That is typically one of the worst states to try to make a decision in. So try to recognize our emotions. The 24-hour rule is one of my favorite rules in terms of when making a big decision. So whether it's an investment decision, a business decision, a family decision, 24-hour rule is a great rule. Take 24 hours, sleep on it before making any major changes to a portfolio or any financial decisions, is a really helpful tip. Have you thought through all the possibilities? A great pros and cons list. Writing things out. I often like to write and journal when I'm trying to solve a problem. Really helps process things, really helps put things into context. So thinking through the possibilities, whether it's verbally or in written form. I'll also add that thinking about what you're making these decisions on, are those factors within your control? So, for example, political policy or congressional policy, for example. We don't know what our lawmakers, policymakers may decide to pass in terms of what final bills look like. If we're making decisions based off of that, that's pretty tough. As much as we like to think that we have maybe some influence and control over that, that can be a pretty tough thing. Or if we're making decisions or off of where we think markets are going, again, things that are out of our control, we want to sort of keep that in mind. So things that you can control, saving, spending, those types of planning topics, those are well within your control and make a lot of sense in terms of basing your decisions around. When making a big change or big decision, whether it's your investment portfolio or otherwise, I think speaking to a couple people makes a lot of sense. 2 trusted contacts, people who can kind of help you think through things, I think are always great. But I also like speaking to folks who might play a little bit of devil's advocate, kind of sort of test you or contradict maybe some of your thoughts. I think making sure getting some balanced sort of advice from both sides of the decision makes a lot of sense. And then one of the things we talk to folks about, and a lot of our work and working with folks has a psychological kind of tint to it in terms of recognizing biases. So personal experiences, for example, if maybe you've grown up in a household where money was a little scarce, that fear might be playing into your decisions around maybe becoming a little bit more conservative in your portfolio, or taking a certain financial step that might be a little bit more conservative in nature. Or maybe one of your biases could be, gosh, I just read something or I just watched the news and it's making me feel fearful. That's called recency bias, being influenced by things that you've just done recently. So again, this sort of thought process or questions to ask are really a great framework, or some really great things to think through to help kind of take some of the emotions out of the decision-making process. So, all right, I'll pause there for questions. AJ, I think we're good. I'm not seeing anything in the chat, but just wanted to pause there.
Tina, no, we're good. You can keep going.
Great. So the next thing, we want to kind of go from the right brain, which is the emotions, the emotional side of our brain that processes emotions and feelings. We're going to go to the left brain. We're going to talk about markets, how markets work, what drives returns. One of our favorite drawings, we actually have this on a canvas material in our conference room, factors that drive returns. So this is an illustration by an author named Carl Richards. He wrote this book called The Behavior Gap. And I think it's extremely pointed, basically breaking down the things that drive market returns. Stocks, the percentage of stocks that you have in your portfolio. Oh, I'm sorry, behavior first. So not bouncing in and out of the markets, not making emotional decisions. 2, stocks, percentage of stocks in your portfolio. And then small stocks and value stocks. The things that don't drive market returns, and he infuses a little humor here, saying market timing, stock picking, CNBC, and your brother-in-law. So always appreciate Carl Richards' humor there. So one of the things we talk about during periods of market volatility, and sort of especially when economic indicators come out, it's important to distinguish that the economy and the stock market are two different things. The economy, in terms of factors, GDP, unemployment numbers, etc., those are a snapshot in time. Markets, what the stock market does, is actually what they call a leading indicator. It is actually forward-looking, not backward. So if a particular economic indicator comes out, let's say unemployment increases, perhaps markets are negatively affected by that in a particular trading day. Well, the markets are basically saying, or particular companies are saying, that they expect a decrease in future cash flows because of an economic indicator that has been released. So in that case, market prices come down. A good piece of news comes up, market prices go up, or stock prices go up. So again, markets are factoring in current information and looking at how this is going to affect the future cash flows of companies going forward. So needless to say, markets are reacting to that information second by second, millisecond by millisecond, if not faster. So if we try to make decisions based off of information that comes out right now, that came out yesterday, that is possibly coming out tomorrow, markets have probably already reacted to it in some fashion. So see here. So the next slide I want to focus on here is regarding, it's actually a very pointed graph regarding recession concerns. So back in, this particular graph is for the S&P 500 back from January of 2007 to 2010. So obviously the financial crisis, largest market correction since the Great Depression. So during this time frame, a recession is defined by two successive quarters of declining GDP. So the recession, if you will, was announced somewhere in the neighborhood of somewhere between midway between 2008 2009. So this is just the announcement that the recession has been announced, and then eventually the end of the recession was announced post 2010. Well, if you had made a decision to get out of the market when the recession was announced, well, you've already written down some of this risk. You've already written down the markets possibly in your portfolio. If you got out right here and said, you know what, I'm going to stay out until I decide or until I've received an announcement the recession is over, well, guess what? You would have missed quite a bit of return along the way. So again, based off of announcements, based off of recession announcements, various news items, really, really tough to try to time the market. We often tell folks that when you're trying to time the market, you got to get it right on two sides, when to get out and when to get back in. And those are really two tough things to do. So going back to a little bit of the point about how markets factor in information on a pretty quick basis. So just double check something here real quick. News breaks, and that information, public information, of course, gets priced right into the markets within seconds, if not faster. Trading continues throughout the day, throughout the week, factoring in that information. Investors make decisions based off of that information, and ultimately, stock prices come to an equilibrium. What the buyer and the seller ultimately agree on is a fair price to trade that stock. It's important to know, again, that markets are factoring in that information extremely quickly, but I often like to tell folks that for every buyer, there's a seller and vice versa. So if there are more sellers in the market, you're going to see market prices come down. If you have more buyers in the market, you're going to see prices go up. But there's an equal exchange there that happens. And that's what drives the markets. So important piece of information to know there. Let's see, market timing. Yeah, entries and exits can be extremely difficult. So let's say you decided to try to time the market. I often tell folks it's like trying to find a needle in a haystack, and I think this graphic really helps explain that. So again, this is the S&P 500 index performance from 1990 to 2024. This is the total period of return for that index. So if you hung tight for 54 years, an annualized return of about 10.6% for that time frame. So riding out through the roller coaster. If you were a market timer and you missed the one best day of that period, your return would have been decreased by about 0.5%. If you missed the best 5 days, about a little over a percentage point in terms of reduced return. 15 days, 7.3, so a couple percentage points. And then if you miss the best 25 days, about basically a half of, your return is sliced in half. So what does that tell us? If you are trying to bounce in and out of the market, you might be missing very, very few days that actually drive a lot of the long-term performance. So if you're trying to miss the bad days, you may miss some bad days, but you may miss some best days as well. So trying to time the market and only stick the time frame that you're in the markets for a very short period of time. Again, trying to find the needle in the haystack. So. And then one of the additional points that we like to sort of share about market research and what sort of history has shown us is how quickly markets snap back. And like I said, they snap back and they snap back quickly. So if we look at total US stock market from 1926 to 2021, we look at when markets were down about 10%, and the return that happened after a 1-year period, after a 3-year period, and a 5-year period. So some pretty nice returns after a 10-year period, or excuse me, a 10% market decline. With a 20% market decline, again, returns after a 1-year period, a 3-year period, and a 5-year period, and then the same thing, slightly different for a 30% market decline. Maybe the 3-year period was a little bit tough to overcome, but again, pretty positive markets 5 years out. So again, I think we fully recognize that it's tough when you're in the thick of it, as we have been in the last several weeks. But again, keeping that longer term perspective is really important, and letting the history of the market sort of drive us and provide us some focus can be really helpful. And one of our favorite charts in terms of helping solidify market discipline and the fact that investors have been rewarded for their discipline over the years, despite all the chaos in the markets. This particular graph marks some of the major market occurrences since 1970, and then shows the return of a portfolio. I believe this is the MSCI, so this is the world index, so global stocks. If you invested $1 in 1970, it at the end of 2024 was worth $117. Add some zeros behind that to make it more meaningful. But you can see a lot of the major market corrections and events that occurred, and so on and so forth. Something kind of interesting, obviously the pandemic back in 2020 is probably the most notable correction that we've seen. In the grand scheme of things, kind of a small blip on the map. So kind of interesting when provided some long-term context. But I think we always emphasize investing is a long-term game, long-term plan. It is not a get-rich-quick scheme. I think a lot of folks sort of think that way, in terms of investing in stocks and trying to trade and win it big and so on and so forth. True investing is a long-term game. So,
I just want to comment. That's a really helpful reminder, especially right now. One of the comments that we get pretty commonly is that things are different now, or we're in an unprecedented time. But really looking at this graphic, every time period with significant market movement was a pretty unprecedented time. So I think this is a great demonstration that despite how things might look on the headlines or in daily conversation, markets tend to keep moving forward regardless of what the short term is telling us.
Absolutely. Let's see here. So the next topic, I just want to keep an eye on the time here. So the next topic we want to kind of talk about are potential planning topics, smart decisions that you can make through planning to kind of help ride some of this roller coaster out. So one of the things we like to talk about is focusing on what you can control. Planning is one of those things that you can control. Spending, saving, trying to reduce tax liability based off of current tax law and rules, estate planning, retirement planning, those are things that you have some control over. So one of the most underrated strategies is making sure that you have an emergency savings fund. I believe the average household in the US is only $500 away from getting themselves into a massive amount of debt. So having an emergency savings fund of about 3 to 6 months of your every month, everyday cash flow needs is a smart thing to be doing. It can provide that buffer as well as help weather some of this investment storm. It helps prevent from having to liquidate investments at an inopportune time to fund any sort of short-term goals or intermediate goals. So we definitely don't want to sell stocks when stocks are 20% down in order to fund any sort of investment or portfolio goals or financial goals, excuse me. Taking advantage of cash that might be in an emergency fund, taking advantage of high yield savings accounts. We're often utilizing high yield savings accounts. A lot of the online banks have some very, very favorable rates right now in the neck of the woods of 4%. We're utilizing things like money market funds, same thing in the neck of the woods of 4%. CDs, and then obviously treasury bills, short-term treasury bills are some great, more stable types of avenues to explore for how to invest that emergency savings fund in a smart and prudent way, but still have it extremely liquid to access if and when needed. one of the things that we're often asked is, okay, so how do I get started? How do I figure out the amount that I should have an emergency fund? Well, 3 to 6 months is kind of a general rule of thumb, but what I kind of outlined here is that this is a great way to get started. You don't need to cower through checking statements and go through each transaction and so on and so forth. If you're able to get a handle on a lot of the big ticket items, your mortgage or rent, utilities, loan payments, groceries, household goods, and cell phone bills, and any sort of major bills you have on a monthly basis, take that figure, take those figures, total it, multiply it by 3 for 3 months, or multiply it by 6 for 6 months. That can give you sort of a range in which to sort of target in terms of your emergency fund and what to keep in liquid cash and savings. And again, taking advantage of those high yield savings accounts as well. One of the toughest things is to get started. So this is a great way to get started, and you can kind of build from there. So let's dig deep into how do you evaluate your investment portfolio? How do you evaluate various goals, various timeline for goals, and then aligning your investments accordingly during volatile market periods? So one of the things to think about is if you have shorter term goals, 0 to 3 years is kind of a good sort of range. Those particular investments, you want to invest pretty conservatively. Cash, savings accounts, bonds, those types of things. Things that provide lower volatility and can really protect to meet your more immediate needs, emergency needs, or again, if you're buying a car in a year, if you're buying a car in 2 years, and you have, let's say, $30,000 set aside for that, you definitely don't want to be putting that in the market, subjecting yourself to a lot of volatility. Intermediate goals, 3 to 10 years. And again, this is kind of some general ranges to consider, but you can have a little bit of a balance between maybe cash, savings, bonds, and a little bit of stocks there. But again, keeping in mind what the goals are and selecting risks that's appropriate there. Longer term goals, and I'll maybe even stretch that out not only to just 10 years plus, but even 5 years plus. Having some level of stock exposure, especially for 10 years going forward. If your goals, again, things like retirement goals, travel plans in retirement, those types of things, you definitely want to try to be as aggressive as possible in the stock market because your expected rate of return is a lot larger in a time frame like that. You have a lot of time for your dollars to grow for you, to work for you, but more importantly, you have a lot of time for markets to recover in the event markets go south during a longer term period of time. So again, giving yourself some time in terms of taking advantage of market returns, especially for those longer term goals. I will add, though, that even if you have a 10-year time frame or otherwise for those particular goals, you may not be comfortable with a 100% stock portfolio. So again, looking at those risk profiles in terms of maybe it's a mix between stocks and bonds, even if it's for a 10-year time frame. Again, not only matching what we can consider or historically say markets can help us over the long term in terms of growing our dollars, but also your personal risk and your level of comfort. You definitely don't want to be choosing a mix between stocks and bonds that keeps you up at night. So let's see here. Let me go to the next. So I kind of want to, I'll take a pause here, AJ. I don't know if there's any questions or happy to.
No questions at this time.
Okay, great. So I kind of want to take you through a little bit of how we think about portfolio construction and aligning that with what someone's cash flow needs are out of a portfolio. So bear with me here. So let's say you have $1 million and we're going to pretend like the type of account that it's invested in is not an important piece of information. So let's say you have $1 million to invest. And let's say you told me that I need $40,000, I meaning you, You need $40,000 out of the portfolio a year, no questions asked. So that $40,000 goes towards funding your everyday bills, funding maybe even travel, just whatever you want it to fund. That's what you want, no questions asked. Let's say from a comfort level standpoint, you would like to see of that $40,000, of that $1 million, excuse me, you would like to see about 10 years of that $1 million, or that, excuse me, that annual cash flow set aside in something pretty conservative. So you want to lock away, if you will, or you want to secure as best as possible 10 years of that $40,000 cash flow. That obviously equates to $400,000. It's 10 years times $40,000. That's going to be your bond side of the portfolio. So this is going to be the part of the portfolio that provides stability, still interest bearing, but not going to be subject to the ups and downs of the market like stocks are. Then the balance of the portfolio, which is $1 million minus 400,000 is 600,000. That's going to be in the stock side of the portfolio. So if we are experiencing some extremely volatile periods in the market, we're going to draw that $40,000 out of the bond side of the portfolio, and we're going to leave the stocks alone. So the stock side of the portfolio could be down 10 to 20% in a particular year, in a couple of years. That $40,000 coming out of your portfolio every year, we're going to take it out of bonds. Let's say in a particular year, stocks are doing really well. That 60% drifts upward to about 62, 65%. We may take some of the weightings off the table, take that 5%, throw it into bonds, and now we've secured possibly a couple years of additional cash flow for you. So this is a very sort of practical, back of the napkin way of thinking through how much risk you're willing to take. How much cash do I need for X amount of years to ride through a certain market period? The reason I use 10 years, I think that's a starting point. The average bear market recovery is somewhere in the neck of the woods about 3 to 5 years. So we have some folks who may be a little bit more comfortable with maybe somewhere in the neck of the woods of 5 to 8 years. They want to see their dollars grow a little bit more for various reasons. So have a little bit more in stocks as opposed to a little bit less in bonds. As your portfolio, continues to grow, and your cash flow is relatively secure in the bond side of the portfolio, as your assets grow, you may not need to take on as much risk. So, if we're thinking of a multi-million-dollar portfolio, for example, you may not need to have as much in the way of stocks to drive growth in the portfolio because you have plenty on the bond side to provide for your cash flow. So again, just a practical way to kind of think through your mix between stocks and bonds and what might make the most sense for you. So some additional considerations to think about as factors that you have within your control to sort of ride through some of this market volatility. Diversification is one that we lean on quite a bit. If you have concentrated stock positions, or maybe even if you have concentrated real estate holdings, consider diversifying out of them in a strategic manner. Utilizing an index funds or diversified mutual funds or ETFs as opposed to holding stock positions. Just that level of diversification going from an individual stock position, so let's say you own an individual tech company, going to an index fund that holds thousands of tech companies, the amount of volatility you're going to experience is significantly less. Diversification is always having to say you're sorry. So I always like to tell folks that with a diversified portfolio, you're never going to be the top performer, but you're never going to be the bottom performer. It's always something in between. So the sacrifice you make in terms of having a diversified portfolio that isn't necessarily the top performer, the trade-off for that is a little bit more stability and a smoother ride in the markets. holding a variety of U.S. international emerging markets investments, just not one area of the market. This year is a great example. International stocks are actually positive about 10 to 12% so far this year, whereas U.S. stocks are about break even, if not slightly down. So again, definitely want to diversify across countries as well as across industries. So tech is a really good example. Tech has been hit pretty hard here recently. So again, want to diversify across various industries. Rebalancing can really be a helpful tactic to take during this time. So again, reviewing that mix between stocks and bonds that we've talked about, and considering minor adjustments. So like I said, if you have a 60-40 portfolio, maybe, in the last couple of years, that 60% is a little bit closer to 65%. Sell the 5%, take some of the winnings off the table, throw that into the bond side of the portfolio. And then again, you can kind of rebalance to sort of make some of those adjustments during the market volatility. Tax loss harvesting, again, another underrated strategy. So if you have a non-retirement account, so like a brokerage account, maybe you have a stock or two or a couple different holdings that have some losses, realizing those losses, turning right around and buying something similar but not identical. Those losses that you've then realized, you're able to utilize those on your tax return in some fashion. So great tool. I often refer to it as making some lemonade out of lemons, especially during some market volatility. And I often tell folks, don't try to overtrade. You don't have to fine tune that allocation every day to, 60-40 or 80-20 or whatever that is. You don't want to be overtrading your portfolio. Your portfolio can be basically disintegrate like a bar of soap. The more that you handle it, it just sort of melts in your hands in terms of being subjected to investment costs. Again, riding market volatility, if you buy and sell on a bad day, again, can kind of be eaten away at those unintended costs. And what I'd like to sort of say during periods of market volatility is that it might be an opportunity. This is a huge mindset shift, I think, for folks who maybe aren't as much of a risk taker or maybe new to investing. So this really goes to the old adage of buying low and selling high, buying stocks when they're at a low or lower point than they once were. If you've got some extra cash that you can part with for a long period of time and you're willing and prudently taking on that risk, buying stocks while they're on discount is a great opportunity. So again, some of that can be taken advantage of with rebalancing as well. Maybe you want to possibly take a couple percentage points of your bond portfolio and your retirement portfolio and throw that into stocks. Again, making those minor adjustments can really add some rocket fuel to your portfolio. Again, buying stocks when they're low, you're buying more shares on discount. And then when markets recover, again, it's like adding rocket fuel to your portfolio.
If I could interrupt.
Sure, please.
So I think this is a really great slide. One of the ideas around rebalancing or maybe counter to that is whether we should be moving up or down in our allocation as far as how much stock exposure we have. Do we switch to 40-60 during this environment and then switch back to 60-40 at a later time, which I think you've addressed in your discussion around market timing. But I think this really is the point that the way that a diversified portfolio is structured to fulfill the cash flow needs, but as well as the investment goals, whether times are good or bad, is a really important concept for investors to understand. It's not moving in or out of the market, but being in an allocation that fits their overall risk tolerance. And sort of on a different tangent, in keeping with the original spirit of the tax planning webinar that this was originally intended to be, during times of market volatility is also a great opportunity for tax planning maneuvers like doing Roth conversions. If you're converting at lower prices and then moving those assets from something like a traditional IRA into a Roth account while markets are low, any recovery that occurs, as we expect markets to eventually do, would occur then in a tax-free account. So I think that's a really important note too.
one of my favorite topics, AJ, Roth conversions and tax
Absolutely.
strategy. And I can't believe I forgot to type it on the slide.
That's what I'm here for.
All right. So just rounding out our discussion here. So um, I think we've talked about some of the conversations we've had with clients around market volatility, and I really think it just speaks to the value of having some professional guidance. If you are making decisions based off of emotion, and it's really hard to navigate that, again, having some professional guidance might actually be a good idea. But then also, I think one of the areas where we add value is actually going back to the last slide in terms of rebalancing, tax loss harvesting, those types of things on the investment management side, where there's someone sort of that's looking out for you, that's got your back in terms of, okay, how do we sort of take advantage of a really tough time in the markets, and what strategically can we do in the portfolio to take advantage of that? And then just having a roadmap. I think one of the conversations we have with clients who engage us in retirement planning is looking at, okay, well, markets are down 10%. Let's rerun that Monte Carlo analysis, factoring in that myself and my husband want to retire at 65. If markets are down 10% this year, if they're down 20% next year, how does that affect our long-term plans to retire and our other financial goals? So having that roadmap, having a little bit of a flight course to take with some corrections along the way, again, is where maybe some professional guidance can be really, really helpful. A couple things that I always like to provide really great book recommendations. These two books are two of my favorites when it comes to investment behavior, and again, trying to have some key principles and philosophy to sort of look back to and lean on when markets get tough. So I mentioned The Behavior Gap, Carl Richards. He's actually a former advisor himself, and he started doing these sketches for his clients, and his clients kept coming back to him asking him, gosh, can you mail me that sketch that you did on the back of that napkin, because I can now explain this to my significant other. So he's written an entire book around these sketches, and again, avoiding these sort of big mistakes or bad behaviors to help people navigate the markets. And then a more recent bestseller, The Psychology of Money by Morgan Housel, a fantastic, fantastic book. It not only talks about, again, avoiding those mistakes, but even going on to the planning and spending side of money, some of the biases that sort of affect us, keeping up with the Joneses, trying to think that we're smarter than the collective market and those types of things. He does a great job of capturing some of the psychology there behind investing. So two great book recommendations. I do not receive any compensation. Just want to throw that out there. I've read these books, found a lot of value in them, and a lot of great principles behind them. So as we wrap up, key takeaways: avoiding making emotional decisions when it comes to your financial picture, aligning time horizon with the dollars that you're investing. Again, investment strategies that can smooth out volatility are absolutely crucial. Building a strong foundation, again, having an emergency fund and making sure you have something to lean on if times get tough. And then again, professional guidance can maybe help provide some third-party perspective to especially like it says when emotions run high. Before we get into any questions or any additional thoughts, just want to plug our next webinar, July 18th. We're going to be talking about paths to financial independence, strategies for debt management, and we hope you can join us for that webinar. The other thing that we wanted to plug too was our social media accounts, Instagram, Facebook, LinkedIn, and obviously our website. Feel free to check those out. Our colleague, Andrew Bunavong's on our webinar here. He does a fantastic job of putting really meaningful posts together, really that are applicable for our, three key demographics that we serve: retirees, pre-retirees, and mid-career professionals. And I think there's some helpful tips there. We obviously talk a lot about our community involvement engagement there too. So, and again, if there's ever any questions that you have, myself and AJ are always available to answer any questions. So with that, we've taken up a lot of your time today with just about 5 minutes, 8 minutes left. Happy to answer any questions, or AJ, yeah, if you want to jump in with any other thoughts, and yeah, we'll just kind of keep it a little bit more open forum at this point.
So if you've been holding on to any questions, now is the time to drop them into the chat. If you'd be more comfortable reaching out to us directly, we're happy to continue any discussions offline. For those of you, as Tina said, we will be hosting our next quarterly webinar in July, so look forward to that. I think this is a really, this is a topic that comes up, pretty much every time we experience an environment of market volatility and an uncertainty. And this isn't the first time, it's not going to be the last time. And I think it's really important to have that redirection and that frame of mind that this is part of the experience as an investor. Volatility is a normal part of investments and markets. If volatility didn't exist, there wouldn't really be any opportunity for any of us to make any money as investors. So it is something that, though maybe uncomfortable at times, is something that the average investor has to learn to come to terms with. So with that, Tina, I think that is good to wrap our session today. Again, if anybody wants to reach out with questions, feel free to use the contact information there on the screen. Otherwise, hopefully we'll see you at the next one. Thanks for joining us, everyone.
Thank you all for joining. We'll give a few minutes back to your day, and have a good rest of the week. Thank you all.
Thanks, Tina. Take care, everyone. Bye now.